Hello and welcome to this podcast from the Private Wealth team at Summarise. My name is Leonora and I'm a partner in the Private Wealth team based in Bristol. I'm joined virtually by Mike Hodges, a fellow Private Wealth partner based in our Manchester office. Hello, Mike.
Hi, Leo.
So before we jump into today's topic, we wanted to highlight a very recent accolade at Summarise in that we've won the Accountancy Team Award at the 2025 Wealth Briefing European Awards. We're delighted to have won, and the award is a reflection of our collective commitment to provide the best possible service to our clients while fostering a culture of excellence and integrity across Summarise. Now, on to today's topic. The topic stemming from the autumn 2024 budget that keeps on giving. Today, we're going to talk about the long-awaited consultation documents that were released by the government on the 27th of February 2025. This relates to the changes announced in relation to inheritance tax, specifically around agricultural property relief, APR, and business property relief, BPR. As a recap, where are we now and what are the changes? Firstly, what is APR and BPR? These reliefs reduce the value of business property or agricultural property when working out how much inheritance tax has to be paid, either on death or when you transfer that property into a trust, and at a rate of 100% or 50%. Currently, there's no cap on the amount of the relief that can be claimed, so a landowner can pass down a large estate to the next generation, enabling the farm business to be maintained without a crippling IHT bill should they qualify for 100% relief. The changes that were announced state that from 6th of April 2026, 100% APR and BPR will be limited to a combined £1 million. So any value beyond that figure, relief is only given at 50%. It does also apply to trust-relevant property charges, so tenure charges and exit charges. So we were all promised a consultation document in early 2025, and it has now arrived. We had expected it to be a much broader document than it is, but this actually only specifically relates to how these proposed changes to APR and BPR apply to trusts, i.e. how that £1 million limit will apply to property settled into trust. You may ask, why do we care about a consultation document? Well, it gives us a little indication of how the rules will be implemented, and it provides us as practitioners an opportunity to respond to the various questions raised as to how these new rules will work in practice, and it enables us to feed back on some potential improvements. Whether they're implemented is another matter. So, Mike, as a starter for 10, do you want to summarise the key points from the consultation document? And we can then sort of discuss some of the major points arising in planning considerations for our clients.
Yeah, it's interesting, isn't it? Because it's all about trust, as you've just said. And I think when we first saw this one, we were looking for a second document, and then it became clear there wasn't going to be a second document, or isn't yet. So trusts it is. But there still feels to me there's a distance to go with this. But we can go through where we are, and then, as you say, talk about some of the practicalities. So I suppose key things: separate £1 million allowance, the £1 million complete exemption for individuals and separately for trusts. Then something I really wasn't expecting, the £1 million for an individual refreshes itself every 7 years. So if you think about it, that's very similar, well, the same in fact, as your nil rate band £325,000. So that's going to set us all down the track of do something now, wait for 7 years, go again. Of course, assuming that 7 years we've still got this regime, but that's getting into the politics of the thing. The £1 million is going to apply to chargeable lifetime transfers. So let's say a transfer of assets into a trust, or the 7 years pre-death where you have failed pets, or on your death estate, which can be assets you own, or where you have what we call in the jargon a qualifying interest in possession. I'm not going to get into the technicalities of that. That's a certain flavour of trust where the life tenant person entitled to the income is treated as owning the assets, and they tend to be trusts which are now, frankly, nearly 20 years old, don't they?
And those assets would then also, if they have an interest in possession in that trust, those assets are in their estate for inheritance tax purposes.
That's right.
Unlike discretionary trusts.
Yes. Most of what we're talking about now are trusts where putting the asset into trust means it's not in anyone's estate, which is why we get this 10-year anniversary charge and exit charge. It's because the tax regime isn't happy that it's not in anyone's estate and says, well, it's outside the tax net. It brings it back into its own tax net. I think one of the things that's controversial in a minor way is that the unused allowance isn't transferable between spouses. which is odd because the nil rate band is, the residential nil rate band is, so don't know what the thinking was there. And then some techie changes, which I think we really won't touch, around 10-year anniversary charges, exit charges as assets come into and out of trust. So I think we'll probably ignore those. But to focus on the planning, I think where people now definitely heading, although I'd hesitate to say do your planning now, just in case something goes off in an unexpected direction, and we've still got 13 months or 12 and a half months because we're in the middle of March, is this 7-year point. So I think people are going to start to say, right, every 7 years, you've got £1 million. Also, you've got your nil rate band. So that's £1,325,000. If you're getting really picky, you've probably got 2 years of 3,000 annual exemptions. It all adds up. But you set out a really good example, because I should say to our listeners, you do all the hard work here and I just rock up. So you prep what we're going to say and I don't quite read it, but so credit where it's due. But you've made the point quite rightly. You can transfer 1.65 million into trust every 7 years. And that, if you think about it, £1 million exempt, 650,000, half of which is then covered by your 325,000 nil rate band. So that's not a bad amount. I think it leads you into much more thought about who owns assets now, because that 1.6 you could double up if you've got husband and wife owning. But previously you probably thought, well, does it particularly matter? Now I think it matters what your starting point is as to who owns assets. So I think there'll be way more discussion with our clients, Leo, around who owns assets and who should own assets. But just coming back to this spouse point, thoughts on it not being transferable?
Yeah, I mean, I think that was slightly unexpected that it wasn't going to be transferable. It's, some people might say, well, why does that really matter? But if you look at a husband and wife and say they own a farm that's worth £2 million, and then say husband dies, it goes straight to the wife, no inheritance tax because husband and wife isn't exempt to transfer. And then when the wife dies and passes it on to the next generation, she'll only have £1 million allowance, and that the balancing 1 million will be taxable. Obviously there'll be a relief, but so therefore you need to think about the will and where are assets going, to make sure that you bank that £1 million on each death, to make sure that that full £2 million worth of the farm can be passed on free of inheritance tax. So I think the key thing for clients is look at your will and look at the destination of those assets. And as a sort of a follow on to that point, you also want to look at who owns the properties. So not just land, but for example, if husband and wife own land as joint tenants, then that land would automatically go to the surviving spouse, and so you would have no option or availability of banking that £1 million relief. Whereas if you own it as tenants in common, then it can pass in accordance with your will, and therefore you can bank that. So the key point on that about the transferable allowance is check your will, check who owns what property and how you own each of those properties, and just wanting to make sure that you bank that relief as much as you can. And Mike, are there any other sort of key points that you'd want to pull out?
I think it's interesting, but I think I will certainly be starting to say to clients, you can begin to plan or think about what your planning is going to look like, because I think the direction of travel is clear. We've been asked 9 questions. The questions are not should these changes happen or not. They're really in the detail. So it's happening. I think that's all of the messaging. It is still a 50% discount. So I suppose it's glass half full, glass half empty. You are talking about, we've talked about the 10-year anniversary charge. That's of a maximum of 6%. With this, it's 3%. So it's 3% of the value of your asset, ignoring the £1 million. If it now qualifies for APR or BPR, that people might think, well, that's still better than unrelieved assets. It might be a way to go. I think 2 practical points that struck me when I was thinking about this. One is you could end up with ownership of assets horribly fractured across husband, wife, children, trusts. It makes it messy. I know that's perhaps not something that people worry about day in, day out, but it's certainly in the family company context. I've seen situations where if shareholdings get too widely spread, families can start to fall out because they say, well, hang on, who's pulling their weight and who's a passive shareholder here? So if these rules are forcing people every 7 years to give away chunks of value and spread it around the family, it's not necessarily the ideal if tax weren't driving behaviours. And the other thing that struck me, And I have got a client who died, it's now 11 and a bit years ago, and the estate still isn't sorted. But if the government is saying, well, you've got 10 years to pay your tax, executors are going to have to hang around for 10 years. Now, whether they really want to would be another question. And I suppose it's perhaps, again, quite onerous. If you're an executor, it's not something you take on for fun. And whether you really want to be keeping the whole thing open just so you can pay your final installments, I guess will be a practical issue. But you haven't sorted your tax early on, or with 100% APR, BPR had no tax that you needed to sort out. So
But I think that, I mean, that's a good point. But equally, if you're paying by instalments and there's property, is it not true that HMRC will put a charge over the property? And then if you need to take finance out to pay for that inheritance tax, it's going to be very difficult where HMRC have already got a charge over. So I can see these estates rolling on for years.
I think there are lots of practicalities that we haven't yet bumped up against because we've had the benefit of the reliefs. So no one's had to think about them. So it'll be interesting to see how it goes. But so I think that this is just a sort of tip of the iceberg, isn't it?
Hopefully this is the sort of thing that will, obviously Safri's will be putting a response to the consultation.
Yeah.
But these are the sorts of things that need to be considered. And also, obviously, not only from a sort of administrative perspective, but historically, if someone set up a trust and it was fully relievable by APR or BPR, they didn't need to carry out a formal valuation because there was no tax at stake, because they could claim capital gains tax holdover and there was no inheritance tax. So whereas now, if, for example, we have the family-owned business and they're going to transfer shares in every 7 years, they will need to carry out a valuation at that point. Then you look at minority discount, all sorts of things. And so that's just going to add to their compliance and additional costs, which are, in the current state of play, I can assume will be unwelcome.
Yes, because it all falls back to the taxpayer, doesn't it? And yeah, it's work for professionals, but it's not really where you want to be saying to clients, well, now you need a proper valuation, and that may not be a valuation that HMRC accept because you're into negotiations with the Capital Taxes Office. So it's very, very strange, and see where we get to.
And then also, I suppose, Mike, what about those some clients or listeners might be thinking, oh, it's fine, we set up our trusts before the budget, this won't impact us. Will any of these changes impact those who've set up the trust beforehand?
Not immediately. So if you were pre-budget day, which, just to remind people, is the 30th of October, for the time being, you're okay. And where this £1 million threshold and a 50% relief for BPR, APR start to apply, or will start to apply, as your first 10-year anniversary after that. So that's where you're coming in. And it is the anniversary charge, just to be clear, is the anniversary of the trust being established. So if you established your trust on the 1st of January 2020, your anniversary will be 1st of January 2030. So you've got effectively another 5 years, 4.5 years to think about it. And up until that point, you can, if you've got assets in trust that qualify for the relief, you still get the 100% relief on the assets coming out of the trust. So it's that date. If you've done things or do things in the period from October to 6 April 2026, so in this transition period, then survive 7 years, because in calculating this £1 million, if you've made gifts into trust in that transition period and you die within 7 years, then they will be added together with your death estate to work out whether you've gone over that £1 million threshold. If you survive 7 years, fantastic. Or, and this is getting a bit morbid, if you die before the 6th of April 26, again, you're 100% relief. So there's lots and lots of detail, which is why you and I love tax, Leo, but why clients are probably tearing their hair out and thinking, no, let's not do it. We don't want to worry about these things. But it's going to affect a lot of people. A lot of our clients are going to be in the middle of this.
Have you got any other planning opportunities, you think, sort of as a result of seeing the consultation document?
Actually, a non-planning opportunity, because there's been a lot of talk, going back to my point about ownership being split, about whether that might be a planning technique to reduce value. So what I mean by that is, if you own 100% of a company that has a certain value, if you split that into 10% shareholdings, the 10% shareholding would be discounted. So there has been talk of, well, if you split the ownership across 10 individuals, trusts, whatever it might be, can you get some kind of benefit in valuation terms, and therefore the tax rate that will apply. But there are going to be rules. Again, there's something in the consultation where shareholdings between individuals and the trusts they create are aggregated for valuation purposes. Aggregated isn't the right technical word, but that's the top and bottom of it. So I think HMRC have seen that coming. But again, it goes back to valuing assets and shares, and they're not necessarily easy things to do. As you will know, they get very subjective, don't they? So that's kind of a non-planning point. I think everything else, I was, as I said before we press button on record on this, I was quite surprised that we've got another 7-year window, or we should have said probably as for trusts that £1 million refreshes itself every 10 years. So quite surprised with that. I think there'll be more things that come out of that, but it'll be interesting as we sort of start to make progress on this with specific client situations to see exactly where things land, because I'm not quite sure I can see what people are going to be doing right here, right now.
Yeah, exactly. I mean, I think it's just it. I suppose we were all holding out so much hope that this would provide us with a lot more clarity, but this is only really covering one aspect of the change. You know, I think a lot of people are slightly holding out. Will anything be changed as a result of the tractor marches, etc.? Which I don't think non-political. This is not a Safri's view. My personal opinion, I don't think she is going to change anything, and I think we are going to be stuck with it. But there may be some tinkering around the edges.
I think that's right, yeah. I think the biggest concession, or seen by government as a concession, is you can pay interest-free over a 10-year period. But that's fine at one level, but there's still an amount of tax to pay. And if it's from an illiquid asset, shares in a private trading company, a farming business, not necessarily easy to turn that into liquid cash to pay your tax without some of the family jewels. Yeah.
You know, if they are trying to generate an income, of which even the most successful of farmers will not necessarily be generating a huge amount of profit, do they prioritise saving that amount of tax every year that may be payable every 10 years versus investing in plant and machinery or investing in some other capital expenditure because they're saving for the tax? So it's got the wrong focus when, you know, obviously the Treasury want us to spend more money, want the economy to be flourishing. But if people are then just going to hold the money back to pay the tax, then
I think inevitably, because you have to, you can't just assume it'll be all right. And interesting to see what the multi-generational family businesses and farms, how they react to this. They'll probably be bored with it by the end, because it does feel as if it's been going on for quite a long time. And as you said, I don't think nearly as much clarity as I would have liked from this. So
also, you know, everyone's talking about, and again, we've mentioned this before, everyone's talking about the tractor, you know, the farmers and the landowners, but it's the family-owned businesses that a lot of people still haven't worked out that this is going to impact them as well.
Yeah.
You know, and they need to factor that into the calculations and cash flow, because it just seems to bypass a lot of people.
Yes, I did it last week, and for about the second or third time, to say to a finance director of a family-owned business, you might have to think about that. And that wasn't one where the shareholders, and there are 3 main shareholders, were particularly of an age. So I use my example, you know, walk out in front of the next bus. It can happen, can't it? And it's not something you can plan for other than have a cash reserve somewhere.
Which would be subject to RHT though, so one has to think about that.
Yeah, absolutely. So yeah. It's prime territory for advisors, but sadly not for some of our clients who are the people who we're trying to help generate wealth. So interesting times.
And so what are the next steps then for the consultation document?
The closing date is the 23rd of April, Shakespeare's birthday. And then I'm guessing we're on a timeline to an autumn budget and legislation at that point. We might get the announcement of the consultation results before then. But that's the normal timeline, isn't it? With the draft legislation, as I say, autumn budget ready to come into force from April next year. So that's the most likely timeline, I guess, unless something unexpected happens to derail it or change it.
We'll see what happens in the spring statement.
2 weeks today, Leo.
Indeed. Great. Well, Mike, thank you. Let's watch this space as to what happens once we've submitted our comments and other professional advisors, and hopefully we will have an update for our listeners in due course. We work with a wide range of clients, many UK-based and many live overseas but have interests here, whether that's property, business interests or investments. We advise individuals and families on how best to safeguard, maintain and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax rules in the UK, which can be complex. If you would like to find out more about how Safri's can help you, please head over to the SAFRI website at www.safri.com. However, it is important for me to stress that if you're considering any of the topics discussed today, you must always take professional advice on your individual circumstances.